Understanding the ALM maturity gap in banking. Asset-Liability Management, ALM, is a crucial practice for banks, aimed at balancing the act between managing risks and optimizing profits. However, not all banks are at the same level of ALM maturity, leading to what is known as the ALM maturity gap. Today, we'll delve into understanding this gap and its implications for the banking sector. The concept of ALM maturity. ALM maturity refers to the level of sophistication and effectiveness with which banks manage the relationship between their assets and liabilities. This involves practices like interest rate risk management, liquidity management, and balance sheet optimization. Signs of high ALM maturity. Advanced analytics and risk modeling capabilities. Integrated view of risk management across the bank. Proactive strategy for liquidity and funding. Regular stress testing and scenario analysis. Signs of low ALM maturity. Reliance on traditional, less sophisticated risk management tools. Siloed approach to risk management. Reactive rather than proactive liquidity management. Limited use of stress testing or scenario analysis. Factors contributing to the ALM maturity gap. Technological advancements. Banks with more resources have been able to invest in cutting-edge technology, including AI and machine learning, to enhance their ALM practices. Smaller banks might not have the resources to make such investments, leading to a maturity gap. Regulatory compliance. Global banks are subject to stringent regulatory requirements, which push them towards advanced ALM practices. In contrast, regional or smaller banks, facing less pressure, may lag behind. Talent and expertise. The availability of skilled professionals who can navigate the complexities of modern ALM practices also contributes to the maturity gap. Larger banks often have the means to attract more experienced talent. The impact of the ALM maturity gap. Financial stability. Banks with lower ALM maturity are more vulnerable to market volatility, potentially leading to financial instability or even failure during economic downturns. Competitive disadvantage. Banks that have not advanced their ALM practices may find themselves at a competitive disadvantage, unable to offer the best rates to customers or optimize their profit margins. Regulatory risks. Failing to meet the evolving regulatory requirements can lead to penalties and restrictions for banks, further widening the gap between them and their more mature counterparts. Bridging the gap. Investing in technology. For banks lagging in ALM maturity, investing in technology is a critical first step. This includes not only purchasing new software, but also training staff to effectively use these tools. Strengthening regulatory compliance. Staying ahead of regulatory changes and ensuring compliance can significantly enhance a bank's ALM practices, aligning them more closely with industry leaders. Fostering talent development. Developing an in-house talent pool with expertise in modern ALM practices through training programs and strategic hiring is essential for closing the maturity gap. Conclusion. The ALM maturity gap presents both challenges and opportunities for the banking sector. Banks that recognize and address this gap stand to gain in terms of risk management, competitive positioning, and financial stability. As the financial landscape continues to evolve, achieving a higher level of ALM maturity will be crucial for banks aiming to thrive in the dynamic market environment. Want to learn more? Claire Trithel on LinkedIn.